Good afternoon, ladies and gentlemen. A very warm welcome to you back on Business Today Television. The world of India macro is abuzz about 12 hours ahead of RBI's credit policy that should be with us at 10 a.m. on Friday. There are expectations of yet another rate cut, but with ample liquidity and growth coming back on track, what would be the RBI's governor's thought process in terms of forecast on inflation, forecast on GDP growth, how does the macro look as far as markets are concerned, and of course, what's the capex intensity, how is the liquidity in the market at the moment at 3 trillion rupees, and the way forward. All this and much more, let's discuss with Ms. Rumki Majumdar, Economist and Director at Deloitte. She's been watching India macro with great detail and is absolutely the right person to discuss what should be the way ahead as far as the interest rate curve in India is concerned. Good afternoon to you, Rumki, and a very warm welcome. So what do you think will happen tomorrow at 10 a.m.? A rate cut, or is there a pause in the offing?
Thank you so much for the question. We are actually divided 50-50 because there have been two successive rate cuts, and
Yes.
India really needs few more rate cuts for sure. It's just that how aggressively the RBI would like to pursue these rate cuts is something that we need to look out. Because one, the fact that inflation has come down definitely gives the RBI the elbow room to maneuver its policy rates. But there is already enough liquidity. We also have this rainfall, which has been good. But I think what the RBI would like to monitor is how the rainfall pans out over the next 2 months, because that will be a determining factor of the crop yield as well as the inflation going forward. And that is something which RBI would like to keep an eye on. So if it goes for a rate cut this time, maybe another one, maybe later in the year. If not, then maybe two successive rate cut after it has more data on rainfall, and then decide accordingly.
Okay, so you are in both camps, a 25 basis rate cut, the possibility of being there, and of course, maybe a pause as well. Am I right?
Absolutely, yes. It could
Okay.
be either way. Yeah.
Okay. You don't think there'll be the front loading of a rate cut with 50 basis points tomorrow?
50 basis point will be, even if it goes with the rate cut, I think 25 will be a more prudent move, as I believe, because we think India needs credit boost. That's for sure. We have seen credit growth falling by to 12%, which is like one of the
Yes.
lowest in the last 5 years, and that is something which is a concern, especially the personal consumption spending loans. Consumption loan has been quite low. But that said, as I said, inflation is something which we have had a win over, but it's still a threat, given that we will also likely see an inflation coming from the US. We will probably be importing inflation if the inflation in the US goes up. Second is the fact that if the Fed has gone for a pause, so our interest differential with the US is also narrowing, which will have an impact on the capital flows. So that is the other issue. Of course, our interest rates compared to any of our emerging neighbors like APAC countries is still that differential is high. So we are still attractive in terms of yield returns. But yeah, a lot of moving factors. But 50 basis points tomorrow might be a little too aggressive. But even if RBI goes with it, we expect it will be a 25 basis rate cut.
Okay, so everybody is agreeable on 25, and let's hope that it proves to be true at 10 a.m. tomorrow when the RBI governor begins his speech. Now, Rumki, let's look at the broader macro picture that we have. The RBI dividend came in, which was fairly substantial. The liquidity in the system is fairly decent, 3 trillion rupees as of June 3rd, and of course, we could have had higher credit growth, which is at 9% at the moment. But when you look at India's macro at this point of time, forex reserves, the real exchange rate value of the rupee, as also dampening inflation, what is the feeling that you get? Are there any hot spots, or do you only see green shoots?
Uh, us being optimistic, we probably see a lot more green shoots. The fact that we have seen our inflation one coming down, second, rupee volatility also has come down, given the fact that there is there is an expectation that the US and India will likely come with a trade bilateral trade agreement by the said timelines, and that might help India in dealing with the trade tariffs that are coming our way. Also, of course, a lot of uncertainties in the US as well, because just yesterday, Mr. President announced a 50% tariff on steel. Now, all this will obviously have an implications on inflation, on the demand for exports, especially in steel. All these, and then we are big exporters of steel ourselves. So all this will have implications. But if we can quickly come up with the deal, I think all those risks will come down. And the fact that the RBI has done a fantastic job of keeping the currency stable. I mean, whenever there was a
Yes.
high volatility, the RBI did step in to ensure that stability. And I think what will happen is we will probably be looking at the dollar depreciating. So there will be some appreciating currency as well, and we have so that will help. I mean, help in RBI to improve its reserves, and of course, it will probably be ensuring that there isn't too much of volatility by through open market operations going forward.
Okay, so one good thing is you see more green shoots and are generally more optimistic about macro data. Now there
Yes,
are lots more questions coming up in the answer that you gave me. We'll take it one by one. The rupee. Uh,
yes.
in the month of May, the rupee was the second best performing currency versus the US dollar. It actually improved 1.3%, just behind the Turkish lira. Now, when you see the rupee, and this is the chart that we have for our viewers versus the dollar, what is the feeling that you get when it comes to reduced volatility? And how do you think has the RBI shaped up on this very crucial macro number? It hasn't given us where it expects the rupee to be, but what it has done is introduced order and cut down volatility. What according to you is the REER for the rupee now?
So expectation, we believe the expectation will be around 86, 87 in the medium term, because and could be some appreciative trends coming in if the dollar depreciates, because if the uncertainty around trade accelerates, and if there are more if the decisions that the tariff the Mr. Trump has taken around tariff, and those decisions are properly prolonged, then we will probably see a lot more weaning of confidence in the US economy, and that will have its implications on its yields and the currency. So if that helps in INR where to become more to remain more solid against the dollar, I think it will be much more stable. But if there are uh, bigger shocks, then I think the RBI will have to step in. Thankfully, we have good reserves for the RBI to step in and ensure that stability in the volatility.
Okay. Discussing tariffs was with you was a big no-no, but you've mentioned it twice in your answers. So now I'm going to put in a question.
Of course.
What do you think of the India-UK trade deal? One. And what do you think will be the broader contours of the India-US deal which is in the pipeline? When do you expect it to be signed?
So India UK trade deal has been good. I think this has been going on for 3 years, and over the last 3 4 months, there has been a realization that we really need to tap into the quick wins. And that's what I think the India UK trade deal did. They decided they had certain quick wins, they decided to tap into it, and some of those contentious topics they probably are kind of still talking through and coming, but they didn't want to hold up the whole process. And that tells you that there is an emphasis on quick partnership in terms of exports, in terms of trade, in terms of investments, so that there is the India can diversify and its geographic exposure and tap into better markets. Now, coming to the India US, I think the timeline is 9th of July, and all eyes are on that timeline. Of course, there have been announcements in between that could throw off the discussion, but I think there is a determination. India wants it to happen. I think US also wants to happen. And by 9th of July, at least they will try tap into some of the quick wins, quick asks. India is willing to bring down tariffs. We saw that in the India UK tariffs, a lot of tariffs were brought down. And I think that's something which India will do it for the US as well. We have seen our dependence on US gone up over the years. They have been good partners, trade partners, and investment partners. And I think this, if we come to an agreement, I think India will have a very solid growth prospects coming up, because then a lot of uncertainties will come down, and we need that uncertainties for our investments to pick up.
Okay, let me ask you a completely odd question, Rumki. In the world of economists, especially those working for US consulting firms, and I'm sure you will be having a broader peer group on a WhatsApp group as well. How has your life changed after President Trump has assumed charge? Has it injected more volatility in the mundane lives of economists, or is it par for the course?
Well, it has definitely kept us quite busy with our clients and client conversations, because clearly there has been a lot of uncertainty. When the tariffs were announced, it already meant many of the sectors who have an exposure to the US were concerned, especially pharma, defense. There were some green shoots, there were some challenges, red flags, and all the clients were trying to understand what it means for them. How would that impact their supply chain and inventories, and what they need to do to mitigate these risks. In fact, there have been so many discussions around what all geopolitical risks can actually come up, and what should they be prepared for. So clearly, it has been quite an active quarter for us, since we were expecting certain changes. Of course, April announcement on April 2nd was way different from what we had actually foreseen. And since then, we are trying to see which sectors will likely get exposed more, which sectors will probably will benefit, and where are the sectors which should probably embrace for an impact. And that's an assessment we have been doing. And I think what the government is also trying to do is trying to ensure that sectors which have a big exposure to the US, say, yes, for example, pharmaceutical and say textile, these are the sectors they will try to protect, because they are these are our biggest export destination, plus textile is an employing sector for us. Similarly, defense, we actually see a lot more collaborations with the US, given the fact that we recently came out of a conflict, and we now know that we need to strengthen our defense, and it's much needed. The government will try to increase its budget on spending, and we need technology advancement, and such collaborations will be very, very, very helpful.
So you took it on a straight bat. I was hoping you'll hit the ball out of the park, but let's come back to India macro. Now, in the RBI governor's statement, what do you expect will be his GDP forecast, and where do you think he will peg the inflation at?
So we have reasons to believe that this year will be a bounce back for us. If you look at the private consumption and the investments number last quarter, they were quite strong, despite the volatility. And given the inflation's coming down, interest rates coming down, it will help consumption overall, and this will probably keep the demand improving. And private sector has not been investing because they were not getting a consistent demand signal from consumers. And if that picks up, there will be private investments coming in. 9.4% growth in private investments last quarter kind of tells you that there is an interest to invest. Now we are expecting around 6.5 to 6.7% growth, and we probably will be pegging it even higher. We're still revising our numbers. That said, I think in terms of inflation, we believe this year the two dynamics can play out. If we see a very strong, good, strong agricultural output because
Hmm.
of better rains, and and the food prices remain under control, so that will help in keeping the inflation down, and this will improve purchasing power. Again, but the other part where the risks are is we might import inflation from the West. And second, the fact that if demand remains very strong, then obviously there will be demand side pressure and overheating of the economy, and the supply side has to catch up.
Okay. Hmm.
And if investment doesn't pick up as quickly, then overheating of the economy could actually result in core prices to go up, which has been trending up in the last 3 months. So this is something which something RBI would like to keep an eye on.
Okay. So, a mild uptick on GDP and a mild downtick on inflation. Credit growth at the moment ending March 2025, Rumki stood at 9.8% versus 20% towards the end of March 2024. Is that a worry? You don't see corporates picking up money from banks. Why is it at anemic 9.8%? What do you think is missing?
So one is that interest rates were high, and and especially when the RBI targeted the consumer segment, and especially the unsecured loans, and they dialed down on their efforts to curb that segment, is where I think it did hit the consumption, consumer or personal loan growth. And if you see that segment has come down, the industry loan growth was very modest throughout the year, and for the reasons we explained, that they were not seeing a consistent demand coming up. I think the return on capital employed, that has been doing really well. So they didn't want to touch on that structure as well. Since they're getting good returns from the capital investments, they did not want to make an investment which may or may not be fruitful going forward if things go if the demands do not pick up, or if we see global uncertainties aggravating. So clearly there are many factors which has led to the private investments to remain low. But government actually did a lot of shouldering of investments over the last 4 5 years. I think this year is where the government or capex also came down, and now is probably the time that private investment should pick up. The interest rates are low, and will be lower if there are further rate cuts, which we expect would be. And if we see, what is needed is capital inflows as well. And we are seeing some uptick in FDIs and FIIs. We saw a $81 billion of FDI flowing in India, which is the third highest in FDI flow in India historically. And this is despite all the uncertainties that we have seen. So if there is an interest in foreign investors to invest in India, that would also help private investment to kick in.
Okay. The other important development that's happened is the elevated US 10-year yield and the falling Indian 10-year yield. I'll request the PCI to first show us the 10-year yield for the US, followed by India. A remarkable progress here, Rumki. Somewhere in June of 2021, the yield differential between respective 10-year yields was 480 basis points. It's now narrowed to 190 basis points between Indian US 10-year yield and the US 10-year yield. What do you attribute these developments to, and do we shortly see a day when this yield differential will be zero?
See, the reason why yields in the US have been low, because there's always a demand for yield. US is always considered a safer haven, right? And lately, if you look at the last 3 4 months data, US yields have just gone through the roof, and that tells you that there is a decline in confidence among the investors on treasury. The fact that they have a high debt, and the deficits, and given that they are coming up with a big beautiful bill, which if gets passed, which means the debts will be even larger,
Yes.
Now that makes it very difficult. And if you look at the treasury holding, many of the major countries like China, which held most of the treasuries, a large part of the treasury, they are also kind of reducing their holdings. All these have an impact on the sentiments, on the confidence on the US economy. And that's why you see the treasury yields of the US going up. On the other hand, is the Indian bonds have done really well. In fact, the ever since India has got listed into the emerging bond index, the money raised through bonds has been going up every month, and in the last 1 year we have done fantastically. That tells you that there is a lot of confidence in the Indian economy. A lot of money, people want to invest in India, and that is probably has brought down our yields, which is like around 6.4, 6.5, which is one of the lowest that we have seen in the past 5 years. So clearly the differential has come down because one, US yields going up and our yields coming down. So we expect this differential to remain as such, but bringing it will come down to zero is probably unlikely, because at the end of the day, US still remains safer haven. If you look at any alternatives to US, there aren't many, and that's why there will be always much more confidence on advanced countries and US specifically compared to any other emerging countries, to be honest.
We hope to see this narrow down to double digits, low double digits, and maybe one day a single digit as well. Rumki, we live in eternal hope and the fact that what was the highest Indian 10-year yield that you remember? Then I'll tell you what I remember.
10-year yield, I think 7.5, 7.6 maybe.
Okay,
Uh,
I remember
could be.
13.5.
Oh my God. Okay, that would probably have been at the time when global financial crisis happened.
Yeah,
So
yeah, yeah.
that is a likely one. I was looking at the last 5 years.
I even remember a fixed deposit at 17%. No TDS.
Oh, oh my God, yeah.
The glory days of 1990s. Anyway,
Oh, okay.
uh,
But then, yeah, if you bring down the interest rates, banks will have a tough time because their credit to deposit ratios are already are already very high, and their margins are get shrinking. So it's going to be tough for banks to raise deposits. One, yields are low. Second, and so they cannot, they have to offer much higher yields for the deposits to bring down the CD ratio. Second, now they have a competition with the secondary market. A lot of
yes,
people are investing in the
absolutely.
secondary market. So it's going to be a tough time for the banks to raise money, I suppose.
But I reiterate my hope that we hope to see this yield differential narrow down to low single digits and then maybe narrow completely. My final question to you, Rumki, when you look at the Indian macro picture, uh, are there any red hot spots that need worrying about? Is there something that keeps you awake at night?
One, I would say inflation. We
Okay.
had a victory over inflation after 5 years. If we see the inflation that we saw in last month in April, that is the lowest since 2019 July. So 5 years we have fought against inflation and finally got it down. But there are lots of downside risks, and it can go up anytime. That is one. Second would be is how are we going to cope with the technology change, because that will have an impact on employment, that will have an impact on income generation and income creation, and obviously that will still have an impact on the consumption spending. We need a very robust domestic demand, be it consumption or investments. Investments won't go up unless consumption demand goes up, and consumption demands will not go up unless there is more employment and income creation opportunities. So it's kind of a virtuous circle that has to kick in to ensure that the domestic demand becomes resilient to the external challenges that we are seeing. Last quarter, we saw domestic demand actually drive the growth when exports actually came down quite significantly. And this probably will be a challenge even this year for at least the first half of this year. So in that case, we really need the domestic demand to be much more stronger. So private investment has to pick up. So that is another concern that we have. Companies need to invest, but unfortunately, with technology changes, with global uncertainties, with so many supply chain frictions, and geopolitical issues, of course, even businesses and investors are concerned how and where to invest,
Okay,
especially in the long term.
not to mention President Trump keeping us awake at all points of time and on
Absolutely.
tenterhooks. Thank you so much. I
Absolutely.
think, Rumki, all these and much more is what is being on the table of not only the RBI but for planners at New Delhi. And let's hope that we come up tops on these two. Thank you so much for your time. I hope it was an interesting conversation. You enjoyed as much as I did, at least I did. Thank you so much, and fingers are crossed, ladies and gentlemen, for a 25 basis point cut tomorrow when the RBI governor starts his speech at 10 a.m.
The recent terror attack in Boulder, Colorado, has underscored the extreme dangers posed to our country by the entry of foreign nationals who are not properly vetted, as well as those who come here as temporary visitors and overstay their visas.